Tesla has been one of the most exciting companies of the past decade. Once a trillion-dollar company, Tesla trades like a penny stock. I mean, it's down 60% in the past 4 months. In this video, we'll talk about Tesla's earnings, their growth story, and finally, we'll take a look at their financials to come up with a price to buy the stock. Please note, this video is not for financial advice and is made for entertainment purposes only. Tesla is the market leader of EV manufacturing. They had a huge head start and did everything right. They strategically invested billions of dollars to build several gigafactories all over the world, management is improving efficiency in their operations, and they've kept a clean balance sheet. So, why is the stock down 70%? Well, there is no one right answer. Some people blame it on the acquisition of Twitter, others blame it on Elon being too outspoken in public, and others blame it on lofty valuations and increasing interest rates. The truth is, it doesn't really matter. The only thing that does matter is, can I invest in this company today and get a meaningful return in the future? First, let's head into the most recent Q3 earnings report. The biggest highlight of this report was revenue moving up 56% year over year, while their expenses were up only 2%. This means one thing: margin expansion. Now let's head into Tesla's different product segments. So I know a lot of people like to say that Tesla is more than a car company, and honestly, there is some truth to that. Their software and AI capabilities is a big selling point. They have charging stations, solar panels, and energy storage. But if you just look at the numbers, Tesla makes 85% of their revenues from cars. So I think to be pricing them as a software company is a bit foolish. With that being said, their energy storage segment grew 62% year over year. That growth is incredible, and this is one of the segments I'm super bullish on. Energy storage works super well with Tesla's solar segment. It allows businesses and households to store energy during the day to be used for the night. With failure of power grids in Texas and California, energy storage is becoming more and more necessary to keep power up and running. Another thing I want to touch on is Tesla's most recent price cuts. In July of 2022, Musk said that the increasing price of their Teslas will hurt demand. This proved to be true when Tesla announced that it will be cutting prices to be more competitive. This shows me that Tesla is now a bit more worried about their competitors and are taking the necessary steps to combat that. Now let's take a look at their returns. Tesla has had incredibly high returns historically. This goes to show how effective management is at allocating capital. And it's something I love to see because it shows me that Tesla is improving their margins, and it shows me that management isn't doing anything stupid with their capital. Next, let's move on to their balance sheet. Tesla has a really clean balance sheet. Their cash position is sitting at all-time highs, they have more current assets than total liabilities, and they're paying off their long-term debt with their cash flows. This is something I love to see, especially with interest rates being so high. So you might sit there and ask yourself, if Tesla's revenues are increasing, their margins are improving, and their debt is dwindling, why not just buy the stock? This takes me to my next point, which is valuation. A good company is not necessarily a good investment. Getting high return on your investment is hugely dependent on the price you pay for the company or investment. Just because iPhones are super cool and work really well, it doesn't necessarily mean you can justify paying $5,000 for one. And the same thing applies to investing. So, what is the price I'm willing to buy Tesla at? Because I'd love to be a shareholder of this company in the future. I'm going to be doing 2 separate calculations. First one will be my more aggressive assumptions. These assumptions assume that we won't be heading into a recession, so car sales won't really get affected, and it also assumes margins will keep improving, so competition isn't really going to hurt Tesla's margins. Before we move on to my price target, if you're enjoying this video, leave a like down below and smash that subscribe button for me. Tesla currently has a revenue of $74.8 billion. If we assume it's going to grow at 20% over the next 5 years, with a free cash flow margin of 15 and trading at a price to free cash flow of 22 at the end of year 5, Tesla is a buy today. But the reason I'm not pulling the trigger on it is because I believe these assumptions don't have a margin of safety. If Tesla isn't able to hit these aggressive assumptions, I will do horribly bad on my investment. So let's try that again with a more conservative approach. I think these numbers are more in line, especially considering the competition is stepping up their game, which will drive Tesla's margins down, and a possible economic slowdown will heavily affect auto sales. For these assumptions, we're going to assume a 15% growth rate over the next 5 years, which would take them to $150 billion in revenue, more than Ford, Honda, and Mercedes, which in my opinion is possible, assuming a free cash flow margin of 12.5%, which is a bit higher than they currently have, and finally, assuming they trade at a price to free cash flow of 20, which in my opinion is more than reasonable for a company growing their top line by 15%. This takes the fair value of Tesla to $74 per share. Overall, Tesla is a very exciting company with a revolutionary technology. They have a phenomenal brand and management is doing everything right. But it's not clear to me that today's price offers a good margin of safety. Thanks for watching this video. Don't forget to like and subscribe. Peace.